They're telling you inflation is under control, the Fed's winning, prices are stabilizing, mission accomplished. Jerome Powell's giving victory speeches about bringing inflation back to target. Meanwhile, your grocery bill is still way higher than it was a few years ago. Your rent hasn't come down a single dollar. Your car insurance is through the roof. And now they're cutting interest rates while telling you everything's perfectly fine. Something doesn't add up here. And if you feel like you're being lied to, that's because you're... What's up, guys? It's Tom here, and if you've been following this channel, you know we don't take the headlines at face value. We dig into the actual data. We call out the bullshit before it becomes obvious to everyone else. We called the jobs overcount months before the Bureau of Labor Statistics quietly admitted they'd massively overcounted employment. We flagged Bitcoin's crash when it was sitting pretty at all-time highs, and it dropped exactly like the model predicted. The defensive portfolio strategy has been quietly beating the market while everyone else chased the rally and got burned. And right now, the recession model is sitting at 67 out of 100. That's up sharply in recent weeks. We're officially in the pre-recession phase, and the reason that model is climbing has everything to do with what they're not telling you about inflation. Because what's happening right now isn't just policy mistakes. It's not just bad communication. It's systematic gaslighting designed to make you believe your lived experience is wrong. So let me break down exactly what's happening here, because there are two completely different inflation stories being told, and only one of them is true. Story number one is what you hear every single day on CNBC from Fed officials, from government economists. Core CPI is moderating beautifully. The Fed's got this totally under control. They've successfully engineered a soft landing. Rate cuts are coming because they've wrestled inflation back down to their target. Everything's going according to plan. Story number two is what you're actually living through every single day. You walk into a grocery store and that same basket of food costs dramatically more than it did just a few years ago. That's not moderating. That's not temporary. That's permanent price destruction of your purchasing power. Your mortgage payment on the exact same house is literally double what it was before. Your car insurance didn't just go up a little bit, it exploded higher. Your electric bill, your phone bill, your streaming services, your gym membership, everything costs more, significantly more. And none of it has come back down. Both of these stories can't be true at the same time. And the one that's false, the one that's completely detached from reality, is the one they desperately need you to believe. Here's the mathematical shell game they're running on you, and once you see it, you can't unsee it. They measure inflation as a rate of change, month-to-month changes, year-over-year comparisons. So if prices went up massively last year and they're only going up moderately this year, they pop the champagne and call that victory. Inflation is cooling, mission accomplished. But that's not how your actual wallet works. Your wallet doesn't care about rates of change. Your wallet cares about the price level, the actual dollar amount you have to pay for things, and those price levels never came back down, not even close. Think about it this way, and this might sound crude, but it perfectly illustrates the point. If I punch you in the face really, really hard, and then the next time I punch you softer, technically, the rate of face punching has improved dramatically. The violence is moderating, but your face is still completely broken. That's exactly what happened to prices across the economy. They spiked massively across the board in recent years. Now they're going up at a slower rate, but they're still going up from an already massively inflated base. So when Jerome Powell gets up there and says inflation is back to target, what he actually means, what he's not telling you is that prices are now going up slowly on top of the massive increases they already went up. Your purchasing power never recovered from that initial hit. It's still getting destroyed year after year, just at a pace that sounds reasonable in a press conference. It's like celebrating that you're only losing money in your budget instead of hemorrhaging cash. Like before, you're still getting poorer, just slower. And here's where the whole narrative completely falls apart. They're simultaneously telling you that the labor market is incredibly strong. Unemployment is at historic lows. Job creation is solid and sustainable. So inflation expectations should stay perfectly anchored, and they can confidently cut rates because the economy is fundamentally healthy. But when you actually dig into the employment data, the real data, not the headlines, you see a completely different picture. The recession model I track incorporates dozens of different labor market indicators. And right now they're painting a picture of an economy that's not gradually cooling, it's stalling out completely. Job creation over recent months has been barely enough to keep up with population growth. We need substantial job creation just to maintain the current unemployment rate. Private sector hiring has basically ground to a halt. Layoffs just hit levels we haven't seen since the financial crisis. Continuing unemployment claims are rising steadily, people are losing their jobs, and they're staying unemployed longer. Job openings are falling. The quits rate is collapsing, which means people don't feel confident enough to leave their jobs voluntarily. Small business hiring intentions are negative. So let me get this straight. The labor market is clearly weakening. Job creation is at stall speed, but somehow inflation is completely under control, and the Fed can confidently cut interest rates to stimulate the economy. That's not a soft landing scenario. That's textbook stagflation with a really good marketing department. And here's what they're actually doing behind all the happy talk. They're cutting interest rates into a weakening economy with persistent inflation. That is literally the exact opposite of what sound monetary policy would dictate. If the economy is genuinely weakening and inflation is still elevated above historical norms, basic economics says you let the economic weakness do the work of bringing inflation down naturally. You don't add monetary stimulus on top of existing price pressures. But they can't do that. They can't let the economy actually cool down properly because the government's debt service costs are absolutely eating them alive. Every month, the Treasury stays at these elevated interest rates. They're paying massively more in interest than they budgeted for. So instead, they're taking a massive gamble with your purchasing power. They're betting they can reinflate the economy, boost asset prices, make the debt burden more manageable, all without reinflating consumer prices. They're betting that the inflation of recent years was just a temporary supply chain shock, not a fundamental shift in the inflationary environment. And if they're wrong, if cutting rates into a weak economy with elevated inflation expectations and massive fiscal deficits just makes both the economic problems and the inflation problems worse at the same time, then you get the 1970s all over again, except this time we're starting with government debt levels, corporate debt levels, and household debt levels that would have been absolutely unthinkable back then. The room for error is basically zero. So here's how this whole situation plays out from here. There are really only three realistic paths, and I want you to understand the probability and the implications of each one. Path 1 is what I call the soft landing fairy tale. The Fed cuts rates at exactly the right pace, the economy stabilizes right at trend growth, inflation magically stays right around target. The labor market rebalances perfectly, and everyone lives happily ever after. Stock prices stay elevated, real estate stays expensive but doesn't crash, and your grocery bills finally stop going up. That's what Jerome Powell is betting on. That's what every Wall Street strategist is predicting. It's theoretically possible, but it requires literally everything to go exactly right. The timing has to be perfect, the global economy has to cooperate, geopolitical tensions have to stay manageable, supply chains have to stay stable. It's possible, but it's the economic equivalent of threading a needle while riding a motorcycle. Path 2 is what I call the stagflation scenario. Economic growth stays weak, unemployment starts climbing, but inflation stays persistently elevated. The Fed can't raise rates because that would crash the economy. They can't cut rates because that would make inflation worse. They're stuck. Businesses can't grow because demand is weak. Consumers can't spend because prices keep going up. It's the worst of both worlds, and the model's forecast is showing this as by far the most likely outcome. Path 3 is the crack-up boom scenario. They cut rates too much, too fast. All that money floods into asset markets. Real estate prices explode higher. Stock prices go parabolic. Cryptocurrency goes absolutely insane, but none of that wealth ever makes it to normal people. Instead, everything becomes even more unaffordable. Inflation comes roaring back at dangerous levels, and eventually something in the financial system breaks so catastrophically that they have to raise interest rates into a severe recession anyway. Now, guess which one of these three scenarios hurts regular people the most? All of them except Path 1, and Path 1, the soft landing, is by far the least likely based on historical precedent and current economic conditions. So what does all of this actually mean for your money, your career, your family's financial situation? If you're holding cash in savings accounts or CDs, you're getting systematically destroyed. They're telling you inflation is under control, while your actual cost of living is going up dramatically every year. That's not a small difference. That's a massive wealth transfer from savers to debtors, from responsible people who save money to institutions and individuals who borrowed heavily from you to them. If you're invested in broad market index funds, you're essentially betting that they can thread that needle I talked about. Keep asset prices high while keeping inflation low, maybe they can pull it off. But if they can't, you're exposed to both inflation risk and recession risk at the exact same time. Your portfolio gets hit by falling corporate earnings and rising costs simultaneously. If you're trying to buy a house right now, you're literally competing against Federal Reserve monetary policy. Every rate cut makes houses more expensive because it increases the pool of qualified buyers. Every inflation print makes your down payment worth less in real terms. You're fighting a battle against the money printer itself. And if you're living paycheck to paycheck, if you're working full-time but struggling to make ends meet, you're the canary in the coal mine. You're feeling this squeeze first and hardest. While economists debate whether inflation is under control, you're making real decisions between paying rent or buying groceries, between fixing your car or taking your kid to the doctor. The cruel irony is that the people who can least afford inflation are the ones who get hurt the most by it, and they're the ones who have the least ability to protect themselves from it. And look, I want to be clear about something. None of this is easy. None of this is your fault. You didn't ask for your money to be worth less every single year. You didn't ask for housing to become completely unaffordable for an entire generation. You didn't ask for grocery bills that make you double-check the receipt because surely they made a mistake. You went to work every day, you followed the rules, you tried to save money and build a better life for yourself and your family. And the system changed the rules underneath you. But here's the thing, pretending it's not happening because some government agency publishes a report saying inflation is moderating, that's not going to fix your budget. Believing their statistics instead of your bank account isn't going to make your rent payment any smaller. Bottom line, they are systematically gaslighting you about inflation. The rate of increase is lower than it was at the peak, but the price level is permanently higher. Your purchasing power is still getting destroyed every single year, just at a pace that sounds reasonable in government press releases. And they're cutting interest rates into this environment, cutting rates into a weakening economy with persistent inflation, because they literally cannot afford to keep rates high. The debt service burden would consume the entire federal budget. The recession model currently reads 67 out of 100. That's firmly in pre-recession territory. The yield curve has uninverted, but credit spreads are tight and getting tighter. The labor market is deteriorating faster than anyone wants to admit. Job creation has basically stalled. And they're about to add monetary stimulus on top of an economy that already has sticky inflation baked in. Given all of this, I remain heavily defensive in my personal positioning. I'm carrying a much larger cash allocation than normal despite the inflation tax because I think we're going to get better buying opportunities. I've reduced equity exposure significantly when I'm invested in real assets. I'm focused on things that tend to hold their value during inflationary periods rather than financial assets that can get destroyed by both inflation and recession simultaneously. This is the same defensive positioning I've held for months, and it's outperformed the market substantially with much less volatility. Sometimes the best defense is not playing the game everyone else is playing. Here's exactly what to watch over the next few months, because these data points will tell us which scenario we're heading into. First thing, the next CPI print. If core CPI comes in significantly above expectations, which means inflation is actually reaccelerating, not moderating, that's the moment the market realizes the Fed is cutting rates into persistent inflationary pressure. The recession model jumps to 70, and we start pricing in stagflation as the base case scenario. Second thing to watch, the next Federal Reserve meeting. If they cut aggressively instead of the expected modest cut, that's not confidence in their inflation victory, that's panic. That means they're seeing something in the economic data that's substantially worse than what they're telling the public. Emergency-level policy action disguised as routine monetary policy. Third thing, weekly initial jobless claims. If we get a significant spike in any weekly print, that confirms the labor market is rolling over much faster than expected. The defensive positioning becomes not just smart, but absolutely critical. And fourth, watch the yield curve. If long-term rates drop while short-term rates stay elevated, that's the bond market pricing in economic weakness and Fed rate cuts simultaneously. Classic recession setup. If this analysis gave you insights you're not getting from the mainstream financial media, hit that subscribe button.